The anticipated surge in geopolitical tensions across the Arctic mining and renewable energy sectors is projected to escalate by 50% by Q2 2025. This projection hinges on expert analyses that suggest profound shifts in global alliances and market dynamics driven by factors such as resource nationalism, changing trade policies, and increased competition for critical minerals crucial for the energy transition. Geopolitical fragmentation and market dynamics. A significant report from White & Case highlights that nearly 50% of industry respondents view geopolitical fragmentation as the primary force shaping the mining and metals sector's activities in 2025. The divergence in trade and critical minerals policies between the United States and the European Union, especially under the Biden administration, is expected to lead to increased operational costs and potential supply chain disruptions. Despite these challenges, there remains a sense of optimism in the sector, with 84% of respondents expressing a positive outlook. This optimism is largely fueled by the demand for precious metals, which are increasingly viewed as a safe haven during geopolitical uncertainty. Shifts in demand and supply. The demand landscape is evolving, with China continuing to dominate electric vehicle EV demand, though growth rates are expected to slow. In the past 4 years, China accounted for over 75% of copper demand growth. However, synchronized economic slowdowns in major economies, including the US and Europe, could complicate metals pricing. Conversely, OECD economies are anticipated to ramp up investments in renewable energy, which may alter demand dynamics for critical minerals. Investment climate in mergers and acquisitions (M&A). The M&A landscape in the mining sector is predicted to remain subdued due to high capital costs and regulatory scrutiny. Approximately 37% of industry respondents cite diversification into critical minerals as a primary driver for M&A. Yet, many firms are hesitant to commit to substantial investments without clearer trade protections and stability in regulatory environments. Timeline of events. 2023, the geopolitical landscape begins to shift, impacting global supply chains and resource investments. 2024, heightened geopolitical sentiment disrupts the mining and metals sectors, prompting firms to seek financing and partnerships amid market volatility. Q2 2025, experts predict a marked increase in geopolitical tensions, with firms adapting to rapidly changing market conditions characterized by intensified trade wars and increased scrutiny over mergers and acquisitions. Key factors influencing geopolitical tensions. 1. Resource nationalism. Nations are increasingly prioritizing the control and extraction of their own resources, leading to tensions over access and rights to critical minerals. 2. Trade policies. Diverging trade policies, particularly between the US and EU, are reshaping how firms approach investments and partnerships in mining and renewable energy. 3. Competition for critical minerals. The race to secure critical minerals necessary for clean energy technologies and EVs is intensifying, further complicating geopolitical relationships. Diverging perspectives. Experts from different sources emphasize varied aspects of the geopolitical landscape. International Energy Agency (IEA) focuses on the broader implications of geopolitical tensions for the global energy system, advocating for rapid clean energy expansion. White & Case concentrates on the mining and metals sector, highlighting how geopolitical factors are reshaping operational landscapes and investment strategies. Outlook for the future. As we move toward Q2 2025, the interplay of geopolitical tensions across the Arctic mining and renewable energy sectors is likely to reshape market dynamics and global alliances. While the challenges posed by increased geopolitical fragmentation are significant, the prevailing optimism among industry players regarding the long-term outlook, especially concerning the rising importance of critical minerals for the global energy transition, cannot be ignored. Companies must adeptly navigate these complexities while adapting to a fragmented market landscape characterized by divergent policies and economic conditions. Conclusion. In conclusion, the anticipated 50% increase in geopolitical tensions is set to significantly impact the mining and renewable energy sectors. Firms will need to operate within an increasingly fragmented market where geopolitical factors will dictate the pace and nature of investments. The emphasis on critical minerals will play a central role in shaping future alliances and competitive strategies, making it imperative for industry stakeholders to remain vigilant and adaptable in this evolving landscape. The anticipated 50% increase in geopolitical tensions across the Arctic mining and renewable energy sectors by Q2 2025 presents a complex landscape marked by counterintuitive trends that challenge conventional wisdom about global alliances. Market dynamics and sectoral growth. Below are several counterintuitive insights derived from the content provided. 1. Optimism amidst fragmentation. Despite the expected fragmentation of markets due to geopolitical tensions, a surprising 84% of industry respondents express optimism about the sector's outlook. This optimism persists even as nearly half of the respondents cite geopolitical fragmentation as the primary driver of sector activity in 2025. The prevailing belief is that the demand for precious metals perceived as safe investments during geopolitical uncertainty will counterbalance market disruptions, which contradicts the expectation that increased tensions would lead to overall pessimism in investment sentiment. 2. Demand shifts. While China has been the dominant force in electric vehicle EV demand, accounting for over 75% of copper demand growth from 2020 to 2024, the forecast suggests a slowdown in this growth. This seems contradictory to the narrative that the global transition to renewable energy and electrification would primarily benefit economies like China. Instead, OECD economies are projected to increase investments in renewables, potentially shifting demand dynamics away from China, which could undermine the long-standing perception of China's unassailable dominance in critical minerals markets. 3. Subdued M&A activity. Despite high stakes, the mining sector's mergers and acquisitions M&A activity is expected to remain subdued despite the pressing need for diversification into critical minerals. A notable 37% of respondents view diversification as a key M&A driver, yet the overall sentiment suggests that many firms are hesitant to commit to substantial investments due to high capital costs and regulatory scrutiny. This presents a paradox where the urgent need for strategic consolidation clashes with firms' reluctance to engage in aggressive M&A strategies, defying expectations that increased geopolitical tensions would spur M&A activity. 4. Supply chain realities. Although concerns about supply chain disruptions have lessened thanks to post-COVID normalization, the geopolitical landscape may still lead to significant trade flow shifts that can undercut project economics. This counters the initial assumption that a return to normal would alleviate pressures on supply chains. Instead, the evolving geopolitical dynamics, particularly between the US and China, are likely to create new complexities that could hinder the very normalization that was anticipated. 5. ESG considerations. The retreat from environmental, social, and governance ESG concerns and investment strategies is notable, with a strong emphasis placed on social license to operate over decarbonization efforts. This is counterintuitive given the global push towards sustainability and renewable energy. The fact that 73% of respondents believe that the pullback from ESG will encourage the harmonization of standards or have no impact is indicative of a broader re-evaluation of priorities in the industry, suggesting that immediate social and governance issues may take precedence over long-term environmental goals. 6. Political and economic divergence. The expected divergence in trade and critical minerals policies between the US and EU stands in contrast to the anticipated need for unified approaches to tackle global challenges. The expectation that the Trump administration's policy agenda will raise costs from supply chain fragmentation or slow investment due to uncertainty highlights a potential fragmentation of alliances that could counteract the collaborative efforts needed to address pressing global issues. 7. Middle Eastern investment surge. The Middle East, particularly Saudi Arabia and the UAE, is emerging as a significant player in the mining sector, countering the narrative that traditionally dominant players like the US and China would lead investment flows. Their diversification plans indicate a strategic shift in global investment dynamics, contradicting the expectation that Western nations would maintain their stronghold over critical minerals investments. 8. Emerging market dynamics. The political climate in emerging markets (EMs) has become increasingly volatile, with government interventions potentially rising to include aggressive tactics like hostage-taking of executives to retain control over assets. This creates an unpredictable environment for investment that contradicts the assumption that increased demand for critical minerals would straightforwardly lead to stable and profitable investment opportunities in these regions. 9. AI integration in mining. The integration of artificial intelligence (AI) into mining operations is set to enhance productivity and safety, which runs counter to the prevailing narrative that technological advancements in this sector would primarily focus on sustainability. Instead, AI's role in optimizing operations reflects a dual focus on efficiency and operational viability, rather than solely adhering to sustainability metrics. 10. Decentralization of demand. The notion that demand for critical minerals would remain concentrated in specific regions, particularly in light of China's dominance in EV production, is challenged by the forecast of a more decentralized demand landscape. The anticipated rise in investments in renewables across OECD economies signals a shift that could dilute China's historical advantage in these sectors, suggesting a more competitive and fragmented market environment. In summary, the predictions surrounding the anticipated increase in geopolitical tensions across the Arctic mining and renewable energy sectors reveal several counterintuitive trends that challenge traditional assumptions about market behavior, investment strategies, and global alliances. These insights underscore the complexity of navigating a rapidly evolving geopolitical landscape where optimism, fragmentation, and shifting demand patterns coexist in unpredictable ways. The report on the anticipated 50% increase in geopolitical tensions across the Arctic mining and renewable energy sectors by Q2 2025 highlights several crucial content areas that many readers might overlook, yet their significance cannot be overstated. Here are the key overlooked elements along with their implications. 1. Geopolitical fragmentation as a market driver. While many reports discuss market dynamics in the context of economic growth, the emphasis on geopolitical fragmentation as a key driver of sector activity is significant. Nearly half of the respondents in the White and Case survey identified this as the primary factor influencing market behavior in 2025. The implications of this fragmentation are profound. Market instability. Companies may face an increasingly unpredictable environment where traditional alliances and supply chains are disrupted, leading to volatility in resource availability and prices. Strategic realignment. Firms may need to realign their strategies frequently to adapt to new geopolitical realities, leading to increased operational costs and potential losses if they are unable to pivot quickly. 2. Optimism amid challenges. The report outlines that despite the anticipated fragmentation and volatility, a significant majority, 84% of respondents, maintain optimism regarding the sector's outlook. This juxtaposition of optimism against a backdrop of challenges is noteworthy. Investment opportunities. This outlook suggests that investors and companies see potential growth areas, particularly in precious metals, which are often considered safe havens during geopolitical uncertainty. The investment in gold and silver as hedges against volatility indicates a shift in asset allocation strategies. Resilience in demand. The expectation of ongoing demand for critical minerals tied to the energy transition underscores the importance of these resources, suggesting that companies may still find lucrative opportunities despite broader market disruptions. 3. Shifting demand dynamics. The report highlights a shift in demand dynamics, particularly with China's slowing growth impacting its dominance in electric vehicle (EV) demand and copper consumption. Global supply chain reevaluation. As major economies, the US, EU, and China, experience synchronized slowdowns, firms may need to reevaluate their supply chains and customer bases, leading to potential over-reliance on specific markets being a risk. Emerging markets, the increasing investments in renewable energy in OECD countries could lead to a rebalancing of demand that favors producers outside of China, suggesting emerging markets may become more prominent players in the future. 4. M&A activity and investment hesitancy. The subdued expectations for mergers and acquisitions. M&A activity due to high capital costs and regulatory scrutiny is another overlooked element. Market entry barriers, the reluctance to engage in M&A due to uncertainty surrounding trade protections and regulatory environments may stifle innovation and consolidation in the sector. This could lead to a fragmented industry landscape where smaller players struggle to compete against larger, more established firms. Long-term strategy implications. Companies may need to adopt more cautious long-term strategies focusing on organic growth rather than external acquisitions, which could slow the pace of technological advancement and operational efficiencies. 5. Political and economic interventions. The potential for increased political interventions such as stockpiling critical minerals and implementing tariffs is a critical aspect that could reshape the market landscape. Operational planning. Firms will have to navigate a more politicized environment where government interventions may significantly influence market dynamics, pricing, and investment flows. Cross-border trade complexity. The impact of potential trade agreements like the EU-Mercosur deal might provide new opportunities but also increase complexity in international trade relations, necessitating agile operational strategies. 6. Technological integration and ESG considerations. The report discusses the integration of technology and the evolving perspective on environmental, social, and governance ESG factors. Transformative potential of AI. The adoption of AI and other technological advancements could significantly enhance operational efficiencies and productivity in the mining sector. Companies that leverage these technologies effectively may gain a competitive edge. Evolving ESG landscape. The shift in focus from purely environmental concerns to broader governance and social factors reflects the changing priorities in the industry. Companies will need to adapt their ESG strategies to align with investor expectations and regulatory requirements, which could affect their market positioning and reputational capital. Conclusion. Understanding these nuanced dynamics is essential for stakeholders in the mining, energy, and geopolitical sectors. The interplay between geopolitical tensions, market fragmentation, and evolving demand patterns will shape the future landscape, creating both challenges and opportunities. Companies that proactively adapt to these changes will likely emerge as leaders in an increasingly complex environment, while those that overlook these trends may find themselves at a disadvantage. 1. Geopolitical fragmentation and market dynamics. The mining and metals sectors are projected to undergo significant market fragmentation due to escalating geopolitical tensions. This fragmentation is primarily influenced by diverging trade policies and resource nationalism, particularly between the US and EU. As highlighted by industry respondents, nearly 50% view geopolitical factors as the main driving force behind sector activity in 2025. This fragmentation complicates investment decisions and operational strategies as companies must navigate a landscape marked by inconsistent regulations and supply chain disruptions. The need for rapid adaptation in response to these geopolitical shifts will be crucial for firms aiming to maintain competitiveness. 2. Investment sentiment amid challenges. Despite the challenging geopolitical landscape, there is a prevailing sense of optimism among industry players regarding the outlook for the mining and metals sector. About 84% of respondents express a somewhat or very optimistic view, particularly regarding precious metals, which are seen as safe investments amid uncertainty. This optimism is juxtaposed with caution surrounding investment activities, particularly mergers and acquisitions (M&A), due to high capital costs and regulatory scrutiny. The anticipated growth in demand for critical minerals essential for the energy transition could further influence investment strategies, pushing companies to explore diversification and innovative financing solutions. 3. Shifts in global demand and supply. The demand dynamics for minerals are shifting, with China continuing to lead in electric vehicle EV demand but facing slower growth rates. The synchronized economic slowdown in major economies poses challenges for metals prices, leading to concerns over the sustainability of price levels. However, there's an expectation that investments in renewable energy by OECD economies will create new demand opportunities. This transition in demand underscores the importance of critical minerals in the global energy transition and highlights the need for firms to align their strategies accordingly to capitalize on emerging trends. For strategic M&A landscape and investment barriers, the landscape for mergers and acquisitions in the mining sector is expected to remain subdued due to high capital costs and increased regulatory scrutiny. While 37% of respondents view diversification into critical minerals as a key driver for M&A activities, many firms are hesitant to pursue significant investments without clearer trade protections. This sentiment reflects broader concerns around resource nationalism and the political climate affecting investment flows. The interplay of these factors will determine how companies approach strategic partnerships and capital allocation in a fragmented market characterized by geopolitical uncertainties. In summary, the anticipated increase in geopolitical tensions will significantly reshape the mining and metals sectors, necessitating firms to adapt their strategies to navigate fragmentation, investment barriers, and shifting demand dynamics. While challenges abound, there remains a cautious optimism for long-term growth, especially in the context of critical minerals and renewable energy investments. 1. The Alaska Purchase 1867. The acquisition of Alaska from Russia by the United States significantly altered geopolitical dynamics in North America. Initially viewed as a folly by many, termed Seward's Folly after Secretary of State William H. Seward, the transaction included vast natural resources including gold, oil, and other minerals. The discovery of these resources later escalated tensions and competition among nations interested in Arctic territories and contributed to the development of U.S. interests in the region, especially as global focus on energy resources increased. 2. The scramble for Africa. Late 19th century, the late 1800s saw European powers engaging in aggressive territorial acquisition and competition for resources across Africa. This period, known as the Scramble for Africa, was characterized by geopolitical tensions, with countries like Britain, France, and Germany vying for control over mineral-rich territories. The exploitation of Africa's resources led to long-lasting geopolitical ramifications, including conflicts and the drawing of arbitrary borders that continue to affect international relations today. The competition for resources such as gold, diamonds, and other minerals underscored the significant role resource nationalism plays in geopolitics. 3. The Cold War and the OPEC crisis. 1970s. The geopolitical tensions during the Cold War were exacerbated by the oil crisis of the 1970s, which highlighted the integral role of energy resources in international politics. The Organization of the Petroleum Exporting Countries (OPEC) used oil as a geopolitical tool, leading to embargoes that disrupted supply and heightened tensions between the U.S. and oil-producing nations. This period marked a significant shift in energy policies and alliances as countries sought to secure access to energy resources amidst rising prices and competition for control over oil supplies, leading to a re-evaluation of energy dependency and strategies for renewable energy development. These historical cases illustrate how resource competition and geopolitical tensions can shape global alliances and economic strategies, paralleling the anticipated increase in tensions regarding Arctic mining and renewable energy sectors as outlined in the expert predictions for 2025. The anticipated 50% increase in geopolitical tensions across the Arctic mining and renewable energy sectors by Q2 2025 is expected to reshape global alliances and market dynamics significantly. This prediction, supported by various expert analyses, highlights the complex interplay of resource nationalism, evolving trade policies, and the competition for critical minerals pivotal to the energy transition. Key predictions. 1. Geopolitical fragmentation. The mining and metals sectors will likely experience heightened fragmentation due to geopolitical tensions. A survey conducted by White & Case indicates that nearly half of industry experts view geopolitical fragmentation as a primary driver of sector activity in 2025. Diverging trade policies between the US and EU will exacerbate this fragmentation, impacting supply chains and increasing costs due to regulatory scrutiny. 2. Investment sentiment. Despite the anticipated fragmentation, there remains a strong optimism within the sector, with 84% of respondents believing in a positive outlook. Precious metals, particularly gold and silver, are expected to attract investments as safe havens amid geopolitical uncertainty. As volatility increases, the demand for these assets may rise, providing a buffer against market fluctuations. 3. Demand and supply dynamics. China's dominance in electric vehicle EV demand is projected to slow. Although China accounted for over 75% of copper demand growth from 2020 to 2020, for the synchronized economic slowdown across major economies could impact metals prices adversely. However, increased investments in renewables by OECD countries may shift demand dynamics, creating new opportunities outside of China. 4. M&A landscape. Mergers and acquisitions. M&A in the mining sector are expected to remain subdued due to high capital costs and increased regulatory scrutiny. While diversification into critical minerals could stimulate some M&A activity, many firms are hesitant to commit without clearer trade protections. The overall sentiment suggests that firms will adopt a cautious approach, focusing on securing financing and partnerships amid market volatility. 5. Regional shifts in alliances. The geopolitical tensions are likely to drive realignments in global alliances, particularly as countries like Saudi Arabia and the UAE seek to diversify their economies. Their outbound foreign direct investments (FDI) in the mining sector will continue to grow, reflecting a shift towards securing resource access and enhancing their position in the global market. 6. Technological integration. Companies in the mining and renewable energy sectors are increasingly adopting advanced technologies, including AI and automation, to optimize operations and improve safety. These innovations will play a crucial role in navigating market gluts and enhancing productivity, ultimately supporting long-term growth in a fragmented market. 7. Resource nationalism. The rise of resource nationalism will complicate investment strategies as countries seek to retain more value from their resources. Governments in mineral-rich jurisdictions may impose stricter regulations and seek to negotiate better terms with foreign investors. This trend underscores the importance of establishing strong relationships with host governments and adapting to evolving local policies. 8. Environmental and social governance (ESG) dynamics. Although the focus on decarbonization remains critical, ESG considerations are expected to shift back towards governance and social license to operate. Investors are likely to prioritize firms that demonstrate strong relationships with local communities and compliance with regulatory standards, emphasizing the need for transparency and ethical practices. 9. Stockpiling and strategic reserves. Countries may adopt stockpiling strategies for critical minerals to bolster their positions amid supply chain disruptions. Legislation in the US and other OECD countries aimed at establishing national critical minerals stockpiles could lead to more robust futures markets, influencing pricing structures and investment decisions. 10. Market volatility and price fluctuations. The market is likely to experience heightened volatility, with prices influenced by geopolitical uncertainties and changes in demand dynamics. The interplay of tariffs, trade interventions, and shifting regulatory landscapes will create new price floors for critical minerals, impacting investment attractiveness. Conclusion. The anticipated increase in geopolitical tensions across the Arctic mining and renewable energy sectors by Q2 2025 presents both challenges and opportunities. While firms must navigate a fragmented market landscape characterized by resource nationalism and evolving trade policies, there is notable optimism regarding the long-term outlook. The growing importance of critical minerals in the global energy transition, coupled with advancements in technology and shifting demand dynamics, will play pivotal roles in shaping the future landscape of these interconnected sectors. Companies that adapt to these complexities and foster strong partnerships will be better positioned to thrive in an increasingly volatile environment.